The US is entering a new
the direction
phase.
of the country, and they wanted a change. They wanted something different, and Trump was that something different.
A transformation under Trump's return to power.
I impose powerful 25% tariffs on all foreign steel.
Economic nationalism is back on the table, and tariffs are front and center once again. In this episode, we'll break down how America's power machine really works, the government, the tax system, and the Federal Reserve, and how they all connect to trade.
Social announcing a new round of tariff hikes targeting 6 additional countries.
We'll unpack how tariffs are used as tools, not just to protect American jobs, but to punish rivals like China, and why that can either revive US industry or quietly break the system from within. You'll find out what conditions must be met for tariffs to actually work, and why, without the Fed's help, they can trigger inflation, retaliation, and economic pain at home. We'll show how this affects investors, importers, workers, everyone. From soybean farmers in Iowa to traders on Wall Street. This isn't just about politics. It's about the next industrial revolution, power, money, and survival in a world where every tariff is a gamble, and the price might be paid by you. Quick thing before we start. About 98% of people who watch aren't subscribed. We know, it's easy to miss. Please take 2 seconds to double check that subscribe button. It's a free thing for anybody that watches our videos. Can do to help us here. You're part of building this channel with us and motivate us to bring higher quality production, deeper research, so we can make the complex simple for you. Quick check. Subscribed? Awesome. Drop a like to boost it. We appreciate you being on this journey with us. Thank you. To understand how tariffs work in America, we first need to understand how power works in America. Because here's the truth. The US system is not designed for quick, centralized control, but for shared governance. The US government has 3 branches. The executive, that's the president, the legislative, that's Congress, and the judicial, the courts. Each one checks and balances the others. But when it comes to tariffs, the president holds more power than you might think. Thanks to laws like Section 301 and Section 232, the White House can act fast. Section 301 allows the US to retaliate against countries that use unfair trade practices, like intellectual property theft or forced tech transfer. Section 232 is about national security. If an import threatens America's defense, like steel or semiconductors, the president can slap tariffs on, no vote required. Congress technically has tariff authority, but in practice, they almost never block the president. Tariffs are one of the few tools a modern US president can use unilaterally. This imbalance creates a strange situation. One man can launch a global trade war, but he still needs other parts of the system to make it work. The president may pull the trigger, but he doesn't act alone. Behind every trade move is a web of agencies and advisors, all playing specific roles in the tariff machine. First, there's the US Trade Representative, or USTR. This office negotiates trade deals, investigates violations, and enforces the rules. They're like America's trade lawyers.
Senior Trump administration officials met with their Chinese counterparts in London today.
Then there's the Commerce Department. If a foreign company is dumping products, selling them below cost to kill US competition, Commerce investigates and recommends action. They handle the technical side, tariffs on steel, solar panels, even washing machines. Every product has a case file. And then there's Congress. They don't initiate most tariffs, but they do control the money. During the China trade war, Congress approved over $28 billion in bailout funds for farmers.
It's a good time to be a farmer. We're going to make sure of that.
These were direct payments to offset losses from China's retaliation, proving that tariffs aren't just a tax on imports. they come with real political price tags. So, while the president makes the headlines, the trade war is powered by a full cast: lawyers, economists, investigators, and budget committees. And all of them, whether they admit it or not, are playing a high-stakes economic game with global consequences. Most people think the president runs the economy, but that's not entirely true. Because there's another force, invisible to many, that can move markets in a single sentence.
I'm very curious to hear from the Fed is, are they still planning 2 interest rate cuts, or are we looking at 1 or none?
Meet the Federal Reserve, the central bank of the United States. Created by Congress in 1913, it's not controlled by the president or by voters. Its job: manage the economy by controlling interest rates, inflation, and the money supply. It decides how expensive borrowing is for banks, businesses, and you. Now here's a key concept. The US runs on 2 economic levers: fiscal policy and monetary policy. Fiscal policy, taxes, budgets, government spending, is controlled by Congress and the president. That's the political side of the economy. Monetary policy, on the other hand, is the Fed's domain. No elections, no politics, at least in theory, just long-term economic steering. So if the White House is pushing tariffs and spending big to revive industry, but the Fed raises rates to fight inflation, the 2 levers start pulling in opposite directions. That tension between politics and policy, between fiscal and monetary, is what makes tariff strategy in the US so unpredictable. Here's where things get tricky. Tariffs are supposed to help American industry. Since wages and production costs are higher in the US, that means American-made goods usually cost more. So tariffs try to level the playing field by making foreign goods more expensive. The idea is simple. Make imports cost more, and Americans will start buying local again. But in reality, tariffs often just raise prices across the board. That's inflation. And when inflation rises, well, guess who steps in? The Federal Reserve. Its job is to keep prices stable. If tariffs push prices too high, the Fed may raise interest rates. Higher rates make borrowing more expensive, not just for consumers, but for producers. That makes it harder for factories to modernize, automate, or scale their operations. And here's the irony. Tariffs meant to protect jobs can end up triggering rate hikes due to inflation that lead to slower growth and higher inflation under influence of tariffs. This isn't just theory. We've seen it happen. On the flip side, if tariffs start dragging down the economy, the Fed might cut rates, like hitting the gas pedal. Producers borrow more, increase supply, and prices begin to cool. That's the classic scenario. Tariffs lead to inflation, Fed hikes or holds, economy slows, eventually Fed cuts, producers borrow, supply increases, prices cool. And that's exactly what Trump criticized. When he said, "Jerome is always late," this is what he meant. Because what Trump envisioned was different, more aggressive. Tariffs go up, Fed cuts rates immediately, producers borrow fast, scale production, prices stabilize through new supply. It's a kind of economic judo. Use tariffs to shift demand and use low rates to flood the system with supply. But the Fed has to play along for it to work. Classic scenario, right? On September 17th, the Fed delivered its first 25 basis point cut, setting 4.00% to 4.25%. That's 240 days after Trump's inauguration. It's 216 days from the February 13th memorandum that kicked off the tariffs policy review, and from the formal tariff announcement on April 2nd, it's 168 days, almost half a year. Timing matters, and the reason why the Fed started to cut: slowing job growth trend. that we can track with job openings and labor turnover survey, JOLTS indicator, that went from 8.1 million job openings in January to 7.23 million job openings in September, as well as increasing downside risk for the labor market, that we can see from ADP non-farm employment change indicator, which showed that 32,000 people lost their jobs in the USA during September. That's a key indicator of economy slowdown. That disconnect between fiscal strategy and monetary response is why tariffs often feel like a gamble. Because if the Fed doesn't move in sync, the entire plan can backfire. This is why every president who uses tariffs keeps one eye on the global chessboard and the other on the Fed chair. Tariffs don't work in a vacuum. They work inside a fragile system. Let's look at how this tension plays out in real life. When a president wants tariffs to drive a boom, but the Fed has other plans. First, Ronald Reagan, who served 2 terms as the 40th US president, 1981 to 1989, and Paul Volcker, who also served 2 terms as the 12th Fed chair, 1979 to 1987. Worth to mention that Reagan didn't ask or push Volcker to lower interest rates. Publicly, he backed Fed independence. However, we know that around his second re-election time, he asked the Fed not to hike interest rates until election results. In the 1980s, USA farmers squeezed, steel mills shutting, and Japanese imports, cars, motorbikes, electronics, eating market share. Reagan reaches for protection of USA industries through voluntary export restrictions, quotas, and tariffs. But the Fed keeps rates high to cool down 70s inflation from oil shock. 2 levers pulling in opposite directions. In this table, you can see all tariffs, quotas, and voluntary export restriction that Reagan introduced during his 2 full terms of presidency. And in the last column, you can see what was the interest rate at that point in time. So we can track how tariffs and high interest rates co-performed together and measure how effective those forces were. Start the timeline. 1981, Japanese auto VRs cap imports. Washington caps. Japan at one point 6.8 million passenger cars, just as Americans buy approximately 10.8 million light vehicles. That's roughly 1/5 of the car market fenced off. And interest rates hover near approximately 16.5%. Prices rise, and the twist is classic. Japanese brands start building inside America. At 1982, sugar import quotas. The US locks in a quota framework with approximately 6.9 million short tons raw value, STRV for short. Headroom, while domestic use runs approximately 9 to 10 million STRV, so roughly 31% of demand stays USA made. With money still dear, with approximately 15% interest rate, grocery prices stay supported. Candy makers grumble, growers breathe easier. 1983, motorcycles tariff, Harley safeguard. A temporary tariff hits 700cc bikes. Tariffs are plus 45% year 1, then 35 to 20 to 15 to 10. The US heavyweight imported motorcycles is about 200,000 units, roughly 80% imported versus approximately 71,000 US made. Main rivals: Honda, Yamaha, Suzuki, Kawasaki, plus BMW. Interest rates ease to 8.9%, still pricey, but Harley uses the breathing room to fix quality and lineup. 1983, sugar blends emergency quotas were introduced as some importers were importing sugar as a blend. Loopholes close with a hard stop. Some blended sugar lines go to zero. No wiggle room, no backdoor. With interest rates near 9.3%, downstream users pay more and the sugar price holds. 1983, specialty stainless and alloy quotas and duties under Section 201. A scalpel, not a wall. Flat-rolled steel tariff is 10% in year 1, stepping to 8 to 6 and 4 on consecutive years. Stainless plate tariffs 8 to 6 to 5 and 4. Year 1 annual import caps are rod 19,100 tons, bar 27,000 tons, tool steel 22,400 tons. That's tiny next to a roughly 1.1 million ton stainless alloy market, approximately 1.7 to 2.5% per category. Rates 9.5%. Relief buys time, not an instant boom. Let's track how these tariffs performed under sky-high interest rates and a strong dollar, and measure their effect with 4 gauges: industrial production in manufacturing, all employees in manufacturing, all employees total private, and exports of goods and services. As the point of the trade wars was simple: protect industry and bring production and jobs home. Start with industrial production in manufacturing. Zoom to 1975 to 1990. From 1980 to 1983, when interest rates sit in double digits and the first tariffs, quotas and VERs arrive, industrial output trends down. Next, manufacturing employment. Same window, 1975 to 1990. The pattern repeats. From 1980 to 1983, manufacturing jobs fall from approximately 19.5 million to approximately 16.7 million. What about exports of goods and services? Zoom in and you see the same thing in 1981 to 1983. Sideways, a small bump, then a correction. The bottom line of high double-digit to high single-digit interest rates in 1980 to 1983 is that even with tariffs up, capital stayed expensive and the strong dollar made US goods pricier abroad. Result, firms struggled to invest, modernize and compete. Exports were capped by currency strength that resulted from high interest rates. Continue the timeline. 1984 to 85 additional steel import restraints spread across suppliers. 1985 sugar-containing products get quotas. 1986 quotas on selected EEC goods under Section 301. 5-year machine tool. Cedar Shakes safeguard tariff. US and Japan semiconductor pact and textiles quotas tightened. 1987 100% tariffs on Japan to enforce the chip deal, as well as specialty steel relief extended. Now, watch the macro backdrop finally shift. Between 1983 to 1987, the Fed funds rate falls out of double digits and financing for businesses eases. Big catalyst also was the Plaza Accord at the Plaza Hotel, New York on September 1985. The G5 agreed to push the dollar down against the other G5 currencies. Over the next 2 years, the dollar slides hard on lower rates and Plaza Accord. As a result, US exports gain breath. That's when the real traction shows up. With rates lower and a weaker dollar, manufacturing output stops sagging and goes to new highs. Employment in manufacturing and all private stabilizes, then launches up, and exports begin to trend higher. Trade wars alone didn't spark it. The macro turn did. Takeaway for our story: protection can buy time, but alignment, tariffs with cheaper money and a softer dollar, turns breathing room into actual growth. Now fast forward. Donald Trump serves as the 45th US president, 2017 to 2021, and returns as the 47th, 2025 to 2029. Across both eras, his counterpart at the Fed is Jerome Powell, Fed Chair 2018 to 2022, reappointed 2022 to 2026. New decade, same core question. Can tariffs revive industry if the Fed isn't fully in sync? During Trump's first term, new tariffs covered roughly $360 to $370 billion of imports, anchored by about $335 billion from the China Section 301 lists, spanning steel, electronics, furniture, and more. A full itemization is compiled by University of Delaware's Dr. Sheng Liu. Trump framed it as an economic war and pushed for rate cuts to reinforce it. But Fed Chair Jerome Powell held back and even raised rates. He was cautious. The economy was strong, inflation wasn't out of control, and policy had spent years near zero. He didn't want to overheat the expansion. His aim was to normalize, to move interest rates back toward more typical levels for a healthy economy. Trump lashed out, calling the Fed crazy, even accusing Powell of being a bigger threat than China. Eventually, the Fed did cut rates, but gradually and only after recession fears began to build, and then COVID slammed the economy. It wasn't the coordinated, rapid response Trump wanted. Did Trump's tariffs work? Yes and no. Just like Reagan and Volcker at the beginning, the White House and the Fed weren't in sync. In 2018, Powell hiked toward normal. In 2019, the Fed cut as growth cooled. March 2020, emergency cuts due to coronavirus to near zero and QE. The dollar firmed into 18 to 19, then whipsawed in 2020. Tariffs never got one consistent monetary wind at their back. Industrial production manufacturing nudged higher in 2017 to 18, then softened in 2019. Spring 2020, a cliff drop as COVID shut factories. Manufacturing and total private employment climbed through 2018 to 19, then collapsed in 2020 and recovered into 2021 to 22. Pre-COVID, exports went higher, even with a strong dollar, and then plateaued and were range-bound. The COVID shock sent them down hard. Tariffs did work, at first, because Trump paired them with Buy American pressure. He pushed deals, China's Phase 1 purchase pledges, Europe signaling more US soy and LNG, and a mini-deal with Japan. Some sales jumped, and you can see it in a lift across production, jobs, and exports before the wider COVID shock hit US economy. Both Reagan and Trump had the same play: use tariffs to shield American industry. But in each case, in their first presidential terms, the Fed ran a separate mission, fighting inflation and seeking normalization, not following politics. Biden era, same wall. Despite the campaign rhetoric, Biden kept nearly all Trump tariffs on China. Instead of tearing them down, he reframed them, pairing the duties with industrial policy at home and trade diplomacy with allies. After Trump's term ended, the Fed kept rates near zero through March 2022. In 2020 to 2021, the dollar was generally softer, giving US exporters a modest tailwind. A chunk of the early lift in manufacturing and private employment, and exports, entitled to continuity of Trump's tariff posture that kept pressure on supply chains to localize and to buy US goods. What Biden changed? With allies, he swapped blanket steel and aluminum tariffs for tariff rate quotas, a de-escalation that eased friction with the EU, Japan, and the UK, while keeping leverage. At the same time, he raised targeted rates on China's clean tech lanes, EVs, solar, batteries, and extended solar safeguards, aimed at supply chain security, not just price. In 2022, the Fed accelerated hikes to fight the post-pandemic inflation surge that followed years of easy money and supply shocks, and the dollar strengthened. The ripple effects show up fast. Manufacturing output loses momentum. Manufacturing employment growth cools. Total private jobs keep rising but decelerate. Exports pop, correct, then resume on a slower slope as the strong dollar bites. Takeaway: when the Fed and the White House aren't in sync, tariff strategy stalls. Trump 2.0, context first. Rates in Trump's second term started at 4.5%, higher than in his first term. Back then they were around 0.5% to 0.75%. That means the Fed has room to cut now to support Trump's idea. And before inauguration, Powell had already eased 3 cuts in late 2024, bringing policy from 5.5% to 4.5%. Why did the Fed cut? Inflation had made progress, and the balance of risks had shifted, with downside risks to employment rising as the labor market cooled. Second term, Trump fires tariffs fast. February 1st, 25% on Canada, Mexico, 10% on China in force since February 4th. 2nd of April, Liberation Day tariffs. A 10% global baseline briefly takes effect on April 9th before a 90-day pause, except China, where rates spike into triple digits. Through July, threats and deals stack up. August 7th lands sweeping approximately 15 to 50% bans across dozens of countries. And the latest October threat is to impose a 100% on all products from China in response to Beijing's latest attempt to tighten control over global production of rare earth metals. Tracking what's active versus still under negotiation is messy. These tariffs span dozens of countries, but the key pieces are a global 10% baseline plus a 40% transshipment penalty. And tariffs on China, as the second wave, hit essentially all Chinese origin goods, so its dollar coverage approximately the entire US import flow from China. The US imported about $439 billion in goods from China in 2024. Taken together, announced rates imply a 54% headline tariff burden on China, with additional hikes still on the table. How big is the take? You can see the first jump in customs taxes during Trump's first-term tariffs from $4 billion to $9 billion, a pandemic dip, then a steady grind higher. In 2025, the bars go vertical. Roughly $18 billion in May and $24 billion in June, with year-to-date customs receipts clearing $100 billion plus by early July. It's real money, still just a slice of a $1.8 trillion budget deficit. Alongside tariffs, Trump keeps pressuring and courting firms and countries to build in America, announcing wave after wave of factory, chip, auto and energy projects, roughly $7.3 trillion of investments. It is proof that policy is forcing enticing relocations and capex back home. Remember the Plaza Accord? In April, analysts floated a Mar-a-Lago Accord, a Plaza-style plan to guide the dollar lower. It stayed in rumor think piece territory. No summit, no signatures, but it signals the direction Trump favors, a weaker dollar to boost exports. Trump pushed through a genius act, stablecoin law that lets licensed issuers mint dollar-pegged tokens, but only with 100% cash and T-bill reserves. Mechanics are simple. Customers deposit dollars to issuers like Coinbase that issue USDC. Then Coinbase buys treasuries, and USDC tokens go out to customers. And since the Genius Act was introduced, roughly 100 billion of new stablecoins were minted. It's not the Fed printing, it's private dollar rails that can broaden dollar supply in circulation and add new demand for treasuries, nudging the dollar softer at the margin. In September 2025, Powell delivered a 25 basis point cut to 4.25%, the first move of Trump's second term, citing again rising downside risks to jobs and elevated inflation. As we record, markets expect 2 more cuts by year-end, October 28th to 29th and December 9th to 10th meetings, that should help USA businesses with cheaper financing, but nothing is guaranteed. In summary, Trump's second term so far. Since January, manufacturing output has climbed. A sharp February-March rebound, a brief April wobble, then new summer highs. Manufacturing employment edged lower, implying more output with slightly fewer workers. Total private kept grinding to fresh highs through summer, led by services and construction. And exports hit a new peak in first quarter of 2025 before a mild second quarter pullback. Still above 2024 levels. Momentum intact, but uneven across sectors. If the Fed eases into 2026 and no shock like COVID or global financial crisis blindsides the economy, Trump 2.0 could rhyme with Reagan's second-term expansion, disinflation plus investment plus exports. But watch inflation flare-ups, credit cracks and geopolitics. They are the spoilers that break rallies. Before we dive into how tariffs act like a hidden tax, let's first break down how the US tax system actually works, because it's different from most of the world. Start with corporate taxes. In the US, companies pay a flat 21% federal tax on their profits. No brackets? Just one rate? On top of that, states can add their own tax, from 0 to 12%, depending on location. So a company in Texas might pay less than 1 in California. But taxes on profits are just one layer. Employers in the US also pay a long list of taxes and contributions every time they employ someone. That includes Social Security 6.2%, Medicare 1.45%, federal unemployment insurance, state unemployment, and the big add-ons, not taxes but often required in practice, like disability insurance, state-based healthcare contributions, and many more. That stack changes by state, industry risk, and benefits. But what you need to know is that employers usually pay from 19 to 45% on top of employees' salaries as payroll taxes and contributions. It adds up, and it makes hiring more expensive in the US compared to low-cost manufacturing countries. We won't go deep into those other taxes today. That's a topic for a whole other video. But it's important to know, even before tariffs, doing business in America is costly. And that's why tariffs were pitched as a fix, not just to punish rivals, but to level the field for companies already carrying a heavier tax load. Now here's something strange for people living outside USA. The US is one of the only major economies that doesn't use a value-added tax, or VAT. Instead, they rely on a sales tax. VAT is what most countries use, in Europe, Asia, even Latin America. It's a consumption tax applied at every stage of production and distribution. In the US, it works differently. There's no national sales tax. Instead, each state or city sets its own, and it only hits at the final sale. Rates range from 0% in states like Oregon and Montana to around 10% in places like Louisiana and Washington. But none of that is collected at the border, and that's a huge loophole in the global trade game. A foreign product can enter the US tax-free and only pay a local tax at checkout. Meanwhile, US-made products are often taxed more at every stage, especially when producers pay payroll taxes, corporate tax, and higher cost of compliance. So when politicians say, "We're getting ripped off
by everybody,"
USA system makes it easier and cheaper to bring goods in than to make them locally. So here's where it gets interesting. In the US, you don't pay VAT at every step, and sales tax only shows up at the register. But tariffs, they're more like a silent tax. When goods arrive in the US, it's the importer, usually an American company, who pays the tariff. But they almost always pass that cost to consumer. That means when you buy that fridge or phone or tool set, part of the price may actually be a tariff, but you won't see it on your receipt. Economists call tariffs a hidden consumption tax because they raise prices, but quietly. You feel them without ever seeing them. But here's the bigger idea, that extra cost. It's meant to shift behavior. If foreign goods become more expensive, the hope is that more Americans will start buying local. And when more people buy US-made products, that means more orders for American factories, more local jobs, more reinvestment in US economy. So yes, tariffs are a kind of tax. And yes, the cost often lands on the consumer. But they're also a strategic bet on national resilience and long-term prosperity. Tariffs don't just sit still, they move. Like a punch that invites a counterpunch. And no country hit back harder than China. When Trump hit China with tariffs in 2018, Beijing didn't flinch. They hit back with their own tariffs on US products on soybeans, pork, and dairy, hitting the heartland directly. But China didn't stop there. They devalued their currency by 10% to make Chinese exports cheaper and help cushion the impact of US tariffs. At the same time, Beijing pumped money into its domestic economy, investing in infrastructure, green tech, and consumer markets to reduce dependence on US trade. And behind the scenes, China doubled down on its Belt and Road Initiative, building trade routes with Africa, the Middle East, and Latin America to bypass the US. That's the game China played: absorb the pain, redirect the flow, and quietly make America less central to its long-term growth. Since early 2025, Trump's trade war has taken on new intensity, with tariffs on Chinese goods spiking as high as 145%. That's on top of existing steel, aluminum, and auto levies. China hit back hard, raising tariffs on US products to 84%, then 125% soon after. Their moves targeted farm goods, energy, and industrial imports. Markets obviously reacted. Stocks dropped until Trump announced a 90-day pause for most countries, but China's rate stayed high even after, now averaging approximately 54%. US ports saw a 28% drop in Chinese container imports in June, evidence that today's tariffs are shifting trade flows. While governments fired off tariffs, global businesses quietly made a different move. They shifted production. Nobody wanted to get caught in the crossfire, so companies started moving production out of China into friendlier, cheaper, or just safer countries. Welcome to the world of friend-shoring. Building supply chains in allied countries like the Vietnam or Poland, or nearshoring, bringing factories closer to home like Mexico. Tech companies led the charge. Apple moved iPhone production into India. Tesla sourced battery materials from South America. Apparel brands left China for Bangladesh. Meanwhile, the World Trade Organization was largely sidelined. Trade became political again, less about rules, more about power. So while tariffs made headlines, this was the quieter revolution, a whole new trade map, designed not just for efficiency, but for survival. On the surface, it might seem strange. Why bring production back to the US when so many goods are cheaper to make overseas? Isn't that just bad economics? That logic only works if you're thinking short term. If your only goal is cheap t-shirts in shops and bulk electronics, offshore production makes sense. But that's not the world we're heading into. We believe that Trump, and many people behind him, see something much bigger: the next industrial era. A world where cost is no longer the most important factor, but control is. Because look at China. They're no longer just the world's supplier of plastic toys and cheap furniture. Today, they build smartphones, solar panels, AI chips, electric vehicles, 5G towers, humanoid robots, and many of them are as good or better and cheaper than American versions. These aren't just products, they're platforms. Whoever controls the hardware controls the data, the network, the future. That's why Trump wants to bring it all back. Not just for jobs now, but for leverage later. And this is where it all connects. Because when a country sells advanced products like EVs, smartphones, and robotics, instead of just $5 t-shirts, it brings in far more value per unit. And if that same country also controls the raw materials, lithium, cobalt, copper, then it owns both the inputs and the outputs. That means the wealth stays inside the system. That's what drives trade surpluses, stable currencies, and long-term dominance. It's not about the number of shipments, it's about what's in them and who profits at each step. And this is exactly why Trump and many national strategists see China as a growing threat. China used to be the world's $5 factory, making cheap goods for global brands. But today, China designs, builds, and exports its own high-end brands. That's not low-cost labor. That's direct economic competition with America. Now imagine a world 30, 40, 50 years from now. In that world, factories are fully automated. Everything, from t-shirts to turbines, is built by AI-powered humanoid robots. No labor costs, no unions, no sick days, just machines that work 24/7. And suddenly, location becomes everything. In that world, countries that host production don't just make goods, they collect robot taxes. Just like we tax human labor today, tomorrow's governments will tax robotic labor. The wealth of a country will no longer come from how hard people work, but from how much production they host. If you don't own the robots, you don't collect the tax, you just import and pay. That tax becomes the new national income. And the country that controls the robots, plus minerals, plus machines, they become the economic superpower and hegemon. And this is where Trump's vision extends even further. Why Canada? Why Greenland? Why rare earth mines in Utah, Alaska, the Arctic? Because that's where the next economy is buried. If the US controls the land, the minerals, the ports and the machines, and it's exporting high-end products like EVs and AI systems, then it's not just trading. America continues to lead. So yes, tariffs might raise prices today, but in this vision, they're the opening move in a far bigger game, a strategy to fund the next generation of Americans. The real danger is not that tariffs are bad, but that they're used without a strategy. Without alignment between the president, Congress, Fed, private sector, they just become another layer of cost. The clock is ticking. If Americans want to lead in the future, they need to act now, or risk becoming a tenant in someone else's automated empire. Thanks for watching. Please like, comment what you think about the USA, and subscribe. We appreciate your support. And for more insights into global markets and power plays, visit nextorderalpha.com and see you in the next episode.